Hey, Dan Passarelli here. Well, I was looking at the market today, making some trades in specific stocks, but I looked at the market in general, or the spiders, SPY, because we're less than a day away from the big CPI announcement, followed by PPI the next day. And that's got a lot of potential to move the market. Now, that said, little context to what I'm about to talk about here. We've seen some pretty good ranges lately. Like, for example, today we've had a range of a little over $3. The day before, about $4. And we've seen a lot of these like little mini runs, right? Like the last 4 days, up quite a bit from like down around 390 up to 409, like $20, right? And so I'm looking at the market and I was thinking, would this be a good time to buy some puts to hedge, maybe a long term portfolio, or to spec on it going down? But then again, it really could go up too. It could be a case of buy the rumor, buy the news, right? And so I look at that. I look at us crossing the 20-day moving average and maybe having a gap down here to fill, and the prospect of CPI coming out tomorrow before the open. And I start thinking about straddles, right? Straddles are pure volatility plays, but the problem with straddles is that uh, when you want them, they tend to be pretty expensive, right? And if you look at the VIX, which is a pretty good proxy for the implied volatility of spiders, it's up today. Even though the market's up, the VIX is up. It's trading at 24.22, which is pretty high. Not terribly high above historical volatility, but pretty high. And so I started looking at that and I started thinking, straddle's probably going to be too expensive. But then I look and I come down here and I see that I could buy the 410 straddle. As you can kind of see from looking at this, I did buy the 410 straddle. And I got filled at, I want to say it was $9.62. And so I started looking at the chart and I started thinking, man, it's hard to, and this was, by the way, options expiring on Friday. So I started looking at this and I started thinking, man, like it is almost hard to imagine spiders not moving $9.62, probably tomorrow. If not, certainly, after Wednesday's number, right? CPI. And so I think, yeah, but options are expensive. Usually the straddles are less than that. But, when we get these mini runs sort of all in one direction, the implied volatility still matters, but it matters maybe a little bit less, right? Because if all the volatility is in one direction, I can bust through the break even of that straddle pretty easily. And we do that, we can model it. I've already got this on, but with this trade, if spiders go down below $400.38 or above $419.62, let's just get some context here. That's where we were 2 days ago, or up here, and we'd have to see some pretty good follow through. Even if volatility got completely smashed following the number tomorrow, if we get that move, it's still a winner, right? So it's a speculative trade, and I put it on real small. But that said, this is one way to analyze straddles, and in fact, this is one of the ways that I analyze every straddle. I also always look at the implied volatility and how that factors into things. But this break-even analysis for straddles, again, just look at the break-evens at expiration, and do I think that before expiration it can go outside that range? Gives me an indication of whether or not the trade can be a nice trade, all else considered, regardless of implied volatility. So I wanted to take this opportunity to kind of cover this, because straddles are really, really difficult trades to trade, and I just wanted to share one of the things that I think is really important to look at whenever you look at any straddle trade. So I hope that helps. This is Dan Passarelli. Trade smart.